Welcome back, everyone. Today, May 6, 2026, marks a pivotal moment in the financial timeline as we witness a fundamental, almost tectonic shift in how global commodity markets are behaving. We are currently navigating through what I call the commodity paradox. On one side of the screen, we see gold and silver showcasing robust, relentless growth, completely ignoring the traditional correlations that used to govern their movement. Gold has now firmly consolidated above the historic $4,600 per ounce mark. This isn't just a flash in the pan or a minor technical correction, we are looking at a sustained continuation of the powerful bull run that has defined 2026. On the flip side, Brent crude oil is enduring a period of intense, almost violent pressure. It has crashed through the critical psychological support level of $93, leaving many energy traders in a state of shock. In this comprehensive deep dive, we are going to break down exactly why precious metals are soaring even as energy driven inflation fears seem to be receding. I will provide a detailed technical and fundamental forecast for the coming days, and most importantly, I'll explain how you should be positioning your portfolio to thrive in this new reality. Let's start with the king of metals. Gold's climb above $4,600 is a massive signal to the world that the forces launched at the start of this year are still accelerating. In 2026, gold has officially completed its transformation. It is no longer just an inflation hedge, it has become a systemic insurance policy. The first major factor is the second wave of de-dollarization. Central banks across the BRICS plus nations, specifically China, India, and Saudi Arabia, are continuing to accumulate physical gold at rates that have left Western analysts stunned. They aren't just buying for diversification, they are actively replacing US treasuries with gold to shield their national wealth from potential sanctions or currency freezing. The World Gold Council recently confirmed that Q1 2026 central bank purchases are tracking toward all-time historic highs. Furthermore, while we see signs of tactical de-escalation in the Middle East, which is pulling the war premium out of oil, investors are not selling their gold. There is a deep-seated fear of the unknown regarding regional stability, and smart money is staying parked in safe haven assets because they believe the current geopolitical calm is merely the eye of the storm. Then there is the Federal Reserve factor. Gold typically thrives when real interest rates fall, and as we move through May 2026, the market is aggressively pricing in a Fed policy pivot. With the US economy showing undeniable signs of a structural slowdown, the market expects at least two significant rate cuts before the end of the year. Lower rates eliminate the opportunity cost of holding gold, making it far more attractive than low-yielding bonds. Technically, since breaking $4,500, gold has entered blue sky price discovery. Our immediate support sits at $4,579, and if we hold that floor, the next logical targets for the bulls are $4,680 and even $4,700 before the month is out. Now, let's talk about silver, which is the real wild card of 2026. If gold is steady strength, silver is absolute lightning. We are watching this metal finally emerge from gold's shadow, driven by a big bang in industrial demand. The solar energy industry has hit a massive turning point this year. Global production of high-efficiency solar panels has surged by over 40% compared to 2025. Silver remains the irreplaceable secret sauce for the conductive pastes in these cells. Silver remains the most asymmetric opportunity on the board. Expect a fierce test of the $70 level, followed by a potential breakout toward new decade highs. For Brent oil, the path of least resistance is currently down. If $93 holds as resistance, we could see a slide toward the $88 to $90 zone. My advice for you today is simple. If you are holding physical gold or silver, the mantra is HODL. This macro cycle is far from over. If you are trading the energy markets, keep your stops tight and your eyes on the headlines. Oil is purely headline driven right now. What is your take on this? Are we looking at a permanent re-rating of silver to $100, or do you think the solar demand is overhyped? Drop a comment below and let's start a discussion. Don't forget to like this video and subscribe to the channel so you never miss these critical market updates. Stay sharp, stay informed, and I'll see you in the next one. We are now entering the fifth consecutive year where global silver consumption is outstripping mining output. We are in a structural deficit that cannot be fixed overnight. Mine production is stagnant, but industrial demand is vertical. Because of this, the old conservative targets of $50 or $60 are now in the rear-view mirror. As gold stays at $4,600, the gold-to-silver ratio is under immense pressure to compress. Silver's percentage gains in this cycle could realistically be double or triple those of gold. Some institutional models are now whispering about $85 to $100+ per ounce by year-end as the physical squeeze intensifies. Moving over to the energy sector, we are seeing a bloodbath for the oil bulls. Why is Brent crude plunging toward $93 while metals are mooning? The answer lies in the Strait of Hormuz factor. Earlier this year, the fear of a total blockade in this vital maritime artery, which carries 20% of the world's oil, sent prices screaming toward $110. However, news of restored export routes and successful diplomatic negotiations has stripped that geopolitical premium out of the price almost instantly. Additionally, falling oil prices are actually creating a Goldilocks scenario for gold. Cheaper oil lowers the cost of production and transport, which cools headline inflation. This gives the Fed the green light to be even more aggressive with interest rate cuts. So, paradoxically, the collapse of oil is providing the fuel for the gold rally. Looking ahead at Brent, the technical picture remains bearish. Most major investment banks expect oil to trade in a volatile range between $90 and $110 for the rest of Q2. We might see a brief dead cat bounce to $115 in late May due to seasonal gasoline demand. But the overall trend is shifting from supply-driven panic to a more balanced risk-managed environment. To summarize the outlook for May 7th through May 10th, for gold, expect the bullish momentum to stay intact as long as we remain above $4,579. The target is a test of $4,630 and beyond.